So with that as a preamble, let's look at what risk looks like. And volatility is what I described as being risk. So I'm going to show you a series of graphs that I showed to my introductory finance students. We can discuss it again here. These are the returns, monthly returns of various different assets, where I'm plotting them on an identical scale that goes from minus 30% all the way up to 70%. And these are not annualized. These are the actual monthly realized returns. So not surprisingly, Treasury bills look like a flat line. There's nothing going on there because of the scale that I'm picking. It's very, very rare that you will get returns in a given month more than 3 or 4%. This is long-term Treasury bonds. That's the returns on a monthly basis. This is corporate bonds. Now, you asked a question before about corporate bonds, and here's an interesting fact. The volatility is lower for corporate bonds. You can tell that from comparing it to government bonds. But look at what happened here and here. With corporate bonds, you have major credit events that can cause system-wide defaults, like the financial crisis, as an example. So the risks are actually a little bit different. It's not just volatility. You're now looking at gap risk, and so you've got to be careful about that. Not all risk is created equal. Right now, let me show you the S&P 500. This is the stock market, and you're all familiar with it. You can see that the fluctuations generally lie between, I don't know, 10% and minus 10%. Not that surprising, except that every once in a while, you get some really bad days and bad months, and that's also a characteristic of stock markets. They can crash. And investors, they know that. They take that into account when they invest. Okay. Here's Pfizer, the pharma company. Pfizer is one of the largest pharmaceutical companies in the world, very stable cash flows in many instances, but compare that to the stock market, you see that they're pretty risky, right? It's Pfizer, the market, Pfizer, the market, okay? All right, now, let me show you Genentech. This is Genentech. Yeah. For those of you with MDs, a doctor looked at this and said, this looks like a myocardial infarction. I didn't know what that meant until he translated. That's a heart attack, right? If you invested in Genentech, you might have had a heart attack any number of instances. And of course, I plotted this until December of 2008 because after that, they stopped trading and they were just now part of Roche. This is extraordinary volatility. But yet investors invested. And a lot of them, as you saw from that growth curve, a lot of them made a lot of money. Some of them lost a lot of money, particularly if they sold out after the decline. That's exactly the nature of risk-taking and the challenge of biomedicine. If you're facing this kind of, and Genentech is one of the most well-run, most successful biotech companies in the entire history of the industry. There is a lot of risk in this industry. That risk can be managed if we understand it, if we measure it properly, and we use the right kind of financing tools. And one of the things that I want to argue over the course of the next few classes is that the traditional tools for financing biopharma is not appropriate for these kinds of risks. We're using the wrong tools. You could bang in a nail with a screwdriver, but it's not going to work as efficiently as a hammer. And so we've got a number of hammers that we're going to go through over the course of the next few weeks. So let me now go back to the histogram view of these returns. So this is a histogram of Pfizer's returns, and overlaid on that histogram is a red curve that is the normal distribution with the same mean and the same volatility of the actual data. So first thing you notice is that actually the red curve is not a bad approximation, right, of the histogram. This is reality, the blue bars is reality, and the red curve is the theory calibrated to that reality. But there are some interesting exceptions. For example, notice here we've got a bit of a fat tail in the empirical distribution, and we also have a bit of a fat tail on the other side. Now, Pfizer is one of the largest, most successful, and most stable companies. Let me show you what Genentech looks like. So this is Genentech's distribution. Now, of course, Genentech has been successful if you held on all the way from 1980 to 2009. It looks terrific. You've got a really big positive upper tail. But take a look at the left tail. That's actually pretty sizable. And the normal distribution does not fit nearly as well. You can tell. It's too fat. The histogram is too fat, and it's too peaked in the middle. And so this is part of the challenge. And this is publicly traded pharma and biotech companies. If you think about companies that are still private, the risks are even greater. So we have to think about how to manage, and before that, how to measure these risks.